Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Look at that. 2 shows in a row, and I still kind of have my voice. So I will take that as a win. And it's funny, I'm watching the pollen accumulate outside on all the cars. I'm like, come on, little voice, you can do it. But we're holding strong. We're holding strong. Somewhat. We'll see. We'll see what happens today. But welcome, everyone, to the St. Patrick's Day version. It's Tuesday. Wilmington Mortgage. I'm Tyler Cralle, the aforementioned host of this podcast. I'm all over the place. I'm not doing my normal intro at all. Of course, now I don't know what my script is. What we do here on the show is break down the top stories that are impacting mortgage rates every single weekday when my voice holds up. Of course, I'm a loan officer, Town Bank Mortgage. I'm Tyler Cralle, saying it again. Chiron, I'll pop it up again just for you. And like I'm wearing a green tie. It was the only green tie I had, but it's a Lily Pulitzer tie, so it's got flowers all over it, and so it's like kind of like getting ready for Azalea Festival, but also little green St. Patrick's. It was the only green tie I had, so here we are. All right, so today's like one of the best days. So when you have one of those days where rates fall, and I mean, it's sort of based on a feeling. There wasn't like any data or anything that came out that explained why rates fell. They fell because people were feeling better about what was happening with the Strait of Hormuz, with oil markets. We saw equity markets jump up, bond yields fell. And then today we actually started out. So this morning, well, I guess it was actually last night, Nick Timiraos, a.k.a. the Fed Whisperer, wrote his, I don't even know what you call it. Like he always writes an article right before the Fed meeting, usually, the Monday or Tuesday before the Fed meeting. So, because today is Tuesday, the Fed's meeting. Tomorrow we get the decision and then Powell's press conference. But it's sort of known that like what the Fed is going to be discussing and what they're going to be talking about, sort of Nick Timiraos kind of gets an idea. So it's kind of important to read his piece before the Fed meeting. It kind of gives you an idea of what's going to be happening, gives the markets an idea of where the Fed's mind is at. Reminder, he was the first one to float the idea when the Fed was raising rates to deal with inflation. They were raising them by a quarter, and then they decided to go 50 basis points. Timiraos was the first one to know about it. So it's always kind of important to look what he's writing, because he has given his ear to the Fed governors, and they'll kind of let him know where they're at. And his piece was not good for rates. I mean, it was basically that they're worried about the oil shock. They're worried about public sentiment. And because of that, they're going to maybe be a little more hesitant of ignoring the oil shock. And so the reason I bring that up is that, and we are going to talk about that, is that rates are actually, I thought we were going to see rates jump back up, and they didn't. The 10-year it was down anywhere from about 2 to 3 basis points for the day. I think it may end up down just a little bit, like maybe 1 basis point when all said and done. Mortgage News Daily has a 30-year fixed rate. Their index, they have the 30-year dropping to 6.29%. So that's 2 big moves back-to-back for Mortgage News Daily. So that's a good sign. So another positive day for rates, even if we're not talking about a huge move, the fact that we didn't see kind of a bounce back, I will take as a win. So, okay, let's get to what Nick Timiraos said. So Nick Timiraos, like I said, Fed Whisperer, he writes, it's happening again. For the 5th year running, Federal Reserve officials find themselves expecting inflation to fall back to their 2% goal, only to be confronted with another disruption that complicates the path. First, it was the pandemic's aftershocks. Then the Russian war in Ukraine. Last year, a sweeping tariff program. And now, of course, what's happening with Iran and the oil shocks that are having a big impact on all markets, without question. Officials meeting this week faced a question that would have seemed unlikely a few months ago. It isn't when they will next cut rates, but whether they can credibly keep telling markets to expect a rate cut at all. Big change. I mean, a couple months ago, it was like, all right, when are we going to start rates cuts again? And now it's like, could oil market disruptions be so bad and have such an impact on consumer prices that we actually see rate hikes? So not surprisingly, Tim Rose notes there's three things to watch for tomorrow. One is, of course, the statement from the Fed. Duh. Two, Powell's press conference, always important. This will be the first time Powell's talking about the oil shocks, the war in Iran, all of that. But then third, and he really stressed this, that was the dot plot. We're going to be getting projections from the Fed about what they see happening with interest rates, or the Fed funds rate, what they see happening with inflation, what they see happening with consumer prices, what they see happening with labor market. And this will be our first look this year. This is our first quarterly dot plot that we're going to get. So the big question is, how much does it change from what we saw in December? And like I said, Tim Rose really kind of stressed that. He said the projection forces officials to look ahead, and that's where the picture gets more unsettling. He said the rate projections are likely to dominate the reaction to this week's meeting. And I don't think he's wrong. What's also interesting is he noted that the standard advice for central banks facing an oil shock is to look past it, concluding that the hit to growth and the boost to inflation will roughly cancel out. But that advice assumes the public trust that inflation will come back down. After 5 years of above target inflation and a series of shocks that keeps reminding consumers of rising prices, the trust is harder to take for granted. Minneapolis Fed President Neil Kashari said, "Do we really want another transitory 2.0?" Of course, referencing the famous argument from Powell and the Fed that inflation was transitory, and then it wasn't. And then all of a sudden, we had to raise rates. Mortgage rates jumped. All rates jumped in reaction to, of course, the absolutely bottoming out of interest rates during the pandemic. And so, yeah, I mean, this is tomorrow. We're going to have our answers. We're going to get our statement. We're going to have our dot plot. We're going to have the press conference. Press conference is probably, it's so funny. I feel like I say this every time, but it's like, watch out for the press conference. And then it's not really that impactful. I do think Tim Rose is right that the dot plot is probably going to be the bigger thing. So we'll keep an eye on that. And I almost never do a show on a Fed Wednesday. I'm going to try very hard. I feel like there's always something that happens. I get bogged down with something and I don't get to do it. So I'm going to work really hard to try and do the Fed Wednesday show. That's my goal. All right. I do want to talk about this. Hold on. Let's talk about pending home sales first. So we did get some data today. Pending home sales were actually unexpectedly good. So similar to what we saw with home builder confidence, where we were expecting a negative move, we actually saw a positive move. And the same thing was true for pending home sales. Pending home sales increased 1.8% in February. We will take it to an index of 72.1. That increase marks the first positive monthly reading since November. So we haven't seen a move up since November. And economists were actually projecting a 0.7% decline. So win-win. However, even with the monthly activity, pending home sales were down 0.8% compared to February of last year. So, we're still dealing with those issues. Sorry, water break. Regionally, it was a mostly positive month. Midwest jumped 4.6%. South was up 2.7%. West up 0.9%. And the Northeast was the only one in negative territory, probably because of how cold it was, with sales down 3.6%. And then the South remains the strongest region actually not by far. Well, kind of. The South region with its jump is now at 87.5, the closest to that benchmark level of 100. The Midwest was at 74.3, so not too far behind. But the West and Northeast are way behind, 58.4, and the Northeast was 55.7. National Association of Realtors Chief Economist Dr. Lawrence Yun cautioned that the improvement may not last, noting how the gain in pending contracts was probably because of the drop in interest rates that we saw, drop in mortgage rates, and now they've gone up. And so more than likely, we could see a slowdown in March, unfortunately, at the start of kind of the spring buying season. Speaking of mortgage rates, we got to talk about this. So normally, when it comes to headlines about mortgage rates, it's usually we need to correct to the upside. We have the Mortgage News Daily 30-year fixed average that we talk about here on the program a lot. There's the Fannie Mae data. There's the Mortgage Bankers Association data. So there's a lot of indexes to see where the 30-year fixed is. And for the most part, they tend to go maybe a little bit to the lower side from my perspective, from the rates that I see, because it does matter. I mean, a lot of things go into account, what your credit score is, what your DTI is, all these things, they're part of it. But usually the rate that you're hearing about, if you went to get a mortgage, you'd probably be a little higher than that. That's normally the case. And I mean, that was even true. So before we came on the air, I priced a loan, pretty good loan, like someone with like a good credit score, like close to 800, right around that kind of sweet spot, putting about 20% down. DTI was kind of right around 30%. So like pretty much everything perfect that you want. And the rate was a little higher than the 6.29% that Mortgage News Daily has. Now, of course, you can do other things. You can buy the rate down. There's things that you can take advantage of, but it's close. It's close. What's funny is today I saw this on Twitter. I saw it first. It was Cralle, the betting website. They said mortgage rates surged to 6.86%, and I was like, what? So like it's the highest level since November, which no. And then I was like, where'd this come from? And I was like, oh, well, it's from this horrible Twitter account, which is based on a website called Bar Chart, which like charts economic data. Bar Chart is literally the worst Twitter handle out there. It's 100% boomer clickbait stuff. They were the ones who one time published that like, that there's more sellers than buyers. This is the worst it's ever been in housing history. And it's like, anyone that remembers 2008 knows that that's the stupidest thing anyone's ever tweeted. That I get things have slowed down in housing, but there is not the biggest divide that we've seen between sellers and buyers. Everyone was selling in 2008. There was no buyers. So and it turned out that Bar Chart headline had come from Redfin. And Redfin was saying that this was the worst since 2013. Bar Chart, of course, took it a step further and said that it was the worst ever. And it's just typical, like, the economy's crashing, housing's crashing, doomsday crap. And that's where it came from. And they were quoting this ticker, AFXY30US.RT. I've never seen this before. And they had mortgage rates today at 6.75, which it's almost 50 basis points above where the Mortgage News Daily 30-year index is. And I mean, that's crazy high. And I saw a bunch of loan officers on Twitter just like bashing that. I don't know what that is. I've never seen it before. I guess they just, like I said, Bar Chart loves to post like, oh my God, the sky's falling. They needed an excuse. They found some weird thing that let them do that. But if you see that rates they're not at 6.86, okay? Or 6 points. They are below that, assuming, that's not where the 30-year is, okay? It's lower than that. Oh my gosh. Like I said, usually it's the problem. We got to tell people that actually rates are a little higher than what they're saying. This is one of the few cases where I'm like, no, they're lower than that. All right, we got to go. My voice made it barely through these 15 minutes. You guys enjoy your Tuesday. We'll be back tomorrow for Fed Wednesday. And remember, as always, do not wait to buy real estate. You buy real estate and wait.